Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark. All right, everyone, welcome into another episode of The Financially Free Investor. Today, I've got a good buddy of mine, Calvin Chin, on. We hung out a couple months ago. We got to know each other through a mutual friend, Jay Addis and Go Abundance. And I'm super excited. He's a young hustler. He's done a lot. He's doing a lot of real estate. He's involved in a lot, and he's really helping throw the rope down. So welcome in, Calvin.
Yeah, Jordy, thanks for having me, brother.
Yeah, absolutely, man. Stoked to have you and stoked to hear more about your story. So before we kind of get in to everything, why don't you give us maybe a 2 or 3 minute synopsis of who you are?
Yeah, man. So I'm like everyone else, man. Like I started off, with a 9-to-5 job in tech. I live in San Francisco, and thought that was the path, man. Thought I was super successful, and kind of found my way of understanding, like, dude, like, I don't want to work in this job forever. Like, this is not fulfilling. Like, on my tombstone, it's going to be hard for me to read that. Like, I worked at a tech job for 30 years, and that scared the crap out of me. So, found my way to buy my time and energy back with real estate. I never looked back from there, man.
That's awesome. So what were you doing in tech?
I was in tech sales.
Tech sales.
Yeah.
Okay. What company did you work for?
Man, so I worked for 2 major big companies, right? So out of college, basically found this big company called Oracle, right? So Larry Ellison, database, all that stuff, and went to that. And actually, it was interesting because when we first started, we had like a big training program, right? Where it really did teach a lot of like business acumen and professionalism. And I actually, look back at that. I'm like, I'm grateful for that opportunity to have that, because it did set me up for, a lot of things. And especially in sales in general, that skill is so valuable in real estate, right? So, I'm grateful for those opportunities. After Oracle, went to a company called ADP, which is not the home security company. It's the payroll company. So did that for a few years and started climbing the corporate ladder there too. And, finally made the jump out of there.
Awesome. Cool. So I guess we'll go deeper on how you got started on your journey to financial freedom. Tell us a little bit about that.
Yeah. So kind of what I mentioned before too, like, I was always taught the same thing most people were taught, right? The American dream was to, get good grades, get to a good school, get a good job, and climb the corporate ladder until you're 65. You have no hair and you have a white picket fence and 2.5 kids, right? So literally that was the frame I thought success would be, right? I'd be successful if I could do that. If I had the corner office, if I had a nice W-2, I had the nice car and all that stuff. And, like I mentioned before, it's like I really figured out that was not what I wanted. That was not fulfillment in life. So, started looking at things to get those back, because I think time and energy are your most important assets, and found real estate. And like most people, I think reading Rich Dad Poor Dad was one aspect. I remember my wife, or my girlfriend at the time, my wife now, we were going to Las Vegas for a party, and we had put on Rich Dad Poor Dad on Audible. And it's a 12-hour drive from where we live, and we were on 2x speed, and we finished the whole book on the way there. And when we got there, we were like, wow, like, what are we doing with our lives? Like this, like, we're doing it all wrong. Like, and, we still stayed for the weekend, but we went back and like, just from there on out, like kind of started surrounding ourselves with the right people, consuming as much stuff that we could, books, podcasts, all that stuff. And to be honest, and to be totally transparent and vulnerable, dude, like, I still did. I lacked a lot of the confidence, a lot of self-worth at the time of like, I am smart enough to like be the Grant Cardones of the world and like really make this like a full-time thing. And to be honest, like we actually ended up trying to take the easy way out, right? So the easy way out for us was to, find another real estate investor and give them money. And that way we'll be real estate investors, right? So my wife at the time, we had saved up about $100,000 in our savings account. And, we found a local flipper in San Francisco. She was doing a project in Twin Peaks. And, we decided to be a private money lender on that deal. And handshake agreement, did the deal, and she sold the deal and it went fine. And we were supposed to make a little bit of money. And, we go ask her for the money. She's like, hey, actually, I don't have the money. I moved it over to a development project in Reno without ever asking us. And yeah, that was like 7 years ago now. And guess what? We've never seen the money and we haven't seen it since, right? And so talk about like a really nice awakening into real estate investing. That was our first, experience with it. And, really situation absolutely sucked, but we really could have taken it two ways, right? We could have said one, like, man, this freaking real estate thing is not for us. We'll just work our 9 to 5 forever and be safe and secure, right? Or two, we could have said, and this is what we ended up doing, and I'm grateful that we did, was say, man, the situation absolutely sucks, but what are the learning lessons here? And let's make sure we never freaking do that again. And we'll take it and we'll chalk it up as to really expensive education, right? And that's what we did. And so, yeah, man, from there, decided, and I think the right move, to invest in our own deals and learn our way. And so saved up enough money and bought our first investment property in Dallas, Texas. Just a single family home, long-term rental, conventional loan, all that stuff. And I bought it for $140,000 and, made some mistakes there too, man. I made a mistake of not underwriting for CapEx. And guess what happened the first year? The AC broke and there goes the cash flow year one, right? Mm-hmm. So learned that lesson there. But the second deal we didn't make the same mistake, made some different ones. Sure. Third deal, didn't make the same mistake, made some different ones. Fourth deal, right? Same thing. And just started to gain confidence. And, started to do bigger projects, BRRRRs, flips, Airbnbs, multifamily. We do apartment complexes now, basically apartment complex BRRRRs and stuff. And we've scaled our portfolio to about 161 doors now. But man, like, the lesson to learn there was mostly like, hey, you got to fail forward, but you got to be consistent about it and make sure that you're learning that lesson, and it'll never be a failure if you're learning a lesson there. So,
yeah, no, that's awesome. And I love how you say, there, when you guys lost that money for your first deal, you had two paths that you could have chosen, right? And I think a lot of the times we were talking about this before the call, just mentally where you're at. And it's so easy to like clench up and go, oh man, like I'm never going to do that again. I'm never going to, lose money again. Or like, hey, I'm comfortable where I'm at. Like I'm not going to go and grow. That's awesome that you guys were able to move through that and get to what I think is the higher road, where you're like, hey, we just learned, right? We just learned what not to do. Now we're going to take that knowledge and modify and do it differently, right? Where most people, I think they would have probably taken that loss and gone, you know what? Real estate investors are all crooks. Like we're never going to invest in real estate. And those are like the crabs that are pulling other people down in the bucket when they're trying to escape, right? And because they had one bad experience, but here you are telling us of a very bad experience. I mean, $100,000 is not insignificant. And to lose that, like that's a big deal. So maybe take me through how long from the point where you guys listened to Rich Dad Poor Dad to when you lost on that first deal and you did your first deal. How long was that?
It was probably like 6 to 8 months, I would say. Yeah, in that time frame. And it was a lot of like learning from a fire hose and like just hearing things and hearing ideas, but not really like totally understanding the concepts yet. But I think to your point too, I mean, like one of the things that, I really kind of look back now and see is like, man, like, there's two types of people, right? One person could take the same situation and say, why is this happening to me? And the other one could say, why is this happening for me, right? And I'm lucky that we kind of took that other route. And don't get me wrong, Jordy, like, dude, the situation freaking sucked. Like, were we mad and sad? Absolutely, man. Like, there was a lot of frustration, a lot of anxiety there for sure. And, but, kind of looking back at it, it's like, dude, that mindset aspect was one of the biggest things that helped us really grow in general, right? And it wasn't our last mistake, and it won't be our last mistake. It was our first mistake, but it won't be our last mistake, right? And so, as long as you keep that, one, I think you're going to just live a lot of a happier life, just knowing that, hey, cool, what can I learn from this? And if you keep on doing that, you're going to be successful in a different way. So
Yeah. So then how long did it take from when you lost the money to when you did your next deal? You said it was in Dallas?
Dallas. Yeah. Yeah. So that probably took another 6 months to a year
Okay.
there. So
And what did you guys do differently in that point of time?
well, we did our own deal, right? We weren't telling anyone else. We had control one. I think the mistake I made too in that other deal was just blindly trusting people. So now a lot of the things I do with anything, right, is I always trust, but I verify too, right? So even when I'm working with agents or property managers, right, it's like, okay, you talk to an agent and you ask them, hey, what do you think rents will be there? And they'll say like some number, right? I'll verify with property managers, right? So I trust, cool. Hey, cool. Thank you for the information. Let me go verify this with our property manager and with other people, right? So kind of that checks and balances. So no matter what, like the lesson learned there is, yeah, like trust but verify all day long.
Yeah, that's so good. That's good. Because I mean, just speaking from my experience as a passive investor, I invested in an apartment deal, and there is an inherent amount of trust that goes with that, right? Because you're kind of betting on the jockey, you're betting on the operator that they know what they're doing and they're going to go through with it. And for a lot of people, they really like what they do. And, they don't necessarily want to jump into real estate full time, but they want the benefits of investing in real estate. And so like that deal that I'm a part of, it's in Florida. I think it's 252 apartment units. Like, dude, I'll be honest, that's the most passive money I've ever received, because like the check just comes, right? Faithfully every quarter. And I don't have to worry about tenants or rehabbing or toilets or anything, versus like the deals that I do on my own, where I'm negotiating with HVAC contractors and, every other sub, I'm trying to get painters there. And it's a job, right? Granted, we get really good returns, yet I'm still trading my time for money, if you will. It's not like passive.
And to kind of your point, man, I mean, one of the things, we talk about the pros of, hey, like, cool, the mindset you learn from that, all that stuff. But the cons of that situation, like losing 100K in the beginning, was that I was scarred, right? I was scarred from like partnerships for a while. The next, we'll call it 4 years after that, I was just doing deals myself, and that was it. I wasn't open to partnerships or anything like that. I didn't want to do any partnerships. Right. It wasn't until I got into GoBundance where, I kind of reopened that back up to say, well, if I do really want to scale, I do need to have partners. I do need to either be an LP in bigger deals and partner that way, or be a GP in other deals and partner that way, or raise capital, or do all that stuff. But it took me a long time. And I think, if I were to look back at it too, like, if you want to scale faster, like you do got to find your who, not how, right?
Yeah.
And that was, if I didn't have that experience, maybe, I'm not saying it will, but maybe we would have started earlier to start scaling and partnering and stuff. And now we do all the time. I mean, we partner all the time now, but we're just with the right people.
Yeah. So when you joined GoBundance and started being more open to partnering, what did that look like? Because I've got a very similar story, but I want to hear how your experience was, right?
Yeah. I mean, when I first started, right, I was still doing all stuff myself. And I remember one of my first events I went to, I walked in a room with David Green and David Lauber and all these guys, and they're doing one sheets and stuff, and basically kind of going over their numbers and stuff. And I was like, wow, like, how do they get to that point? Like, I'm doing the math in my mind. Like, how do you do that on, making that much money, like, and placing it that way? Like, you have to get like really good returns and stuff. And what I learned was mostly just like, no, we're using other people's money. We're raising capital. We're partnering with people. I'm doing stuff that I know I'm really good at. And you start to hear more and more stories like that. And eventually it becomes, your own mindset too. You're, in a way, you are the 5 people that you surround yourself with, right? So you keep on hearing that over and over again. And all of a sudden you're like, wow, like, all right, that must be the way, because it's working for a lot of people. So, something has to give. Maybe I'm looking at this wrong. And yeah, I've had a past experience that it sucked, but that doesn't mean that moving forward that I've learned that lesson now, and I can take the lessons I learned and move it over here now and say, you know what, like now I know what kind of partners I want to do. And to your point, Jordy, too, man, partnership opportunities come all the time, right? And I actually say no to a lot of them because it's like, like this actually probably isn't aligned, and that's okay too, right? So you get, to the 90 no's, so you get to the one yes that actually works out for what you're trying to do.
Yeah, that's so good. So you guys are now at, you say 161 doors?
Yeah.
For most people, like that, they're going to be like, oh man, that's way more than I'll ever have. And that's okay. Like, I kind of look at it, there's two paths to grow. You can either, get 10 10 or 20 or whatever rental properties paid for that kind of pay your lifestyle bills, and that gets you to financial freedom. And then there's the other with it leverage and scale, and you're buying small apartments and doing all of that. But knowing what you know now, you've kind of been in both boats, I think. What's the one thing you'd tell someone who's working towards financial freedom?
Yeah. So I think in the beginning, the mindset I had was very much save, then buy, and save, then buy. And in the first 2 years, I did an audit in kind of the last 7 years here, and we were buying like 2 properties a year, right? 2 properties a year, 2 single families a year, things like that. And I would just run out of money. Like, cool, I do it, run out of money, do it, run out of money, save up, run out of money again after you buy another property. And I was doing the math in my mind. I was like, man, this is going to take me forever to get there, right? So I was like, you know what? Like, I don't want to retire at like 60, right? That's no point of that, right? Like, I want to do this faster, right? So I think the leverage aspect was something that we changed our mind as well, because in the very beginning, our actual strategy was we'll buy 2 properties a year, right? And then we'll have each cash flow from each property pay off 1 property, right? Like all the cash from all the properties will pay off 1. And then when that's done, then that's all cash. And then we'll pay off the second one, right? Now we have 2 paid off. We'll do all that cash flow for third, and it kind of compounds from there.
Yeah.
And it was like a 10-year plan on that one. And it was, it was a decent plan, but it was going to take a long, long time. Right. And, luckily, we were in an environment where interest rates were going down and down and down. I remember people talk about interest rates being high right now. I remember getting a flat 5.5% interest rate on a fourplex. And I don't even know what year it was, like 2017 or 2018. And I was pumped. I was like, sweet, that's awesome. And now it's back there. People are freaking out, whatever. But interest rates were going down. It was going down to 4, going down to 3, going down to 2. It was crazy. And it was like, dude, if I can just borrow all this money, it's basically free money, and leverage that free money just to buy more and more properties, let's just do that. Why would I pay off anything right now? So we kind of had that change as well. So that was one aspect. The other aspect was going bigger, right? Going bigger faster. I think it's so cliche. People say that all the time, but it's so true. I mean, do we still do single family homes? Yeah, we do. But I look back right now, and like all my apartment complexes, even the ones we're doing right now, are way more chill and way less work. There's still work, but way less work than our single family homes. Just things that just always come up with single families that are just annoying as hell. So going bigger, faster. And then third is the who, not how, right? Finding the people that complement your superpowers and also your weaknesses. I think I'm self-aware enough to know that I'm good at, and I love doing certain things. And I hate doing certain things. And it drives away energy. So, I define superpower as like something that 1, you're good at, and 2, gives you energy when you do it, right? And so the who, not how aspect is then more about, all right, how can I find people that love doing the things that I hate and drains energy, but that's their superpower, and that gives them energy, and they love doing that. And it's so crazy. You think like, oh no, like people would never love doing that because you hate it. But then you talk to more people, you're like, oh, wow, you are actually the opposite of me. And I love that. The yin and yang right there. So, I think those are the 3 things in my mind that really helped us like really start to take off.
Yeah, man, that's so good. So, I mean, let's talk about the debt for a minute, because I think that's a common thing that a lot of people struggle with is, we're just taught, go to school, don't get in debt. And I agree with that to a degree, because like, having $20,000, $30,000, $40,000 in credit card debt when, you're only making 50 or 60,000 a year is like, that will bury you.
Yeah.
But I believe there's a difference between good debt and bad debt. And, so maybe walk us through how you guys came to that decision and what benefits you saw from, maybe taking some cash out of properties when rates were low to go. Speak to that a little bit.
Yeah, I mean, I think you mentioned there before is like good debt versus bad debt. And I think a lot of people have that mental block, right? I've talked to a lot of students about that. Like you never want to be in debt. Well, you got to ask yourself, well, is this good debt or bad debt? Are you buying a freaking car with this thing, or are you buying something that's actually going to make you money? And like, what I loved about it was just the whole aspect of leverage. Like when you start to learn this more, it's like, well, I can buy something all cash, right? And let's say I buy $100,000 property and I bought all cash. Cool. You spent $100,000 and maybe you're getting like a 7% cash on that, but And then your appreciation, maybe it's like, I think the real estate market over the last like 15 years has been like, I don't know, 10%, around 10%, we'll call it, right? But the cool thing about leverage is, hey, I can use that $100,000 and I could buy, a $500,000 property instead with that money. But the cool thing is that when it starts to appreciate, it's appreciating off the 500,000, not the 100,000, right? So, man, if you go up 10%, you just made what, $50,000 on that property, right? Because of a 10% appreciation just by doing nothing. Versus if you spend $100,000 on stocks and it goes up 10%, then you're making $10,000, right? So that was like something that was like, oh, like that's very interesting to me. I think I can get my head around that for sure.
Yeah, that's so good. So did you guys take cash out and go buy more properties when rates were lower?
Yeah. So that's exactly what we did. We just kept on like scaling up. Like, so cash out, I sold a couple of properties, which I'm, always regretful of, to be honest, but it was all the whole adjective of return on equity, right? So instead of a return on investment, your return on equity, how much equity you built in your property and how much cash flow you're getting. And I was like, oh man, I made so much equity in this property. I'm going to sell it and 1031 exchange it. Looking back at it, yeah, I wish I would just refi it instead. But there were properties that we refied instead as well, where, and those were easy decisions at the time, right? Because it was like, oh, we had a 4.2% rate, but now rates are 3.2. So not only am I like cashed out, but I'm also going to get a lower interest rate too.
Yeah.
So those are easy, but it's an easy way to scale up where you use your assets to buy more assets. And I think at some point, I think Daniel Del Rio actually taught me this, was at some point, you're going to have a momentum of assets, right? That's going to be paying for other assets. And then you just basically plant each seed. And when one seed is blossoming, you pick that and you plant another seed with it. And then that blossoms. Now you have two seeds to plant and pick and blossom. And that's kind of been our strategy, is like, cool, we'll buy properties. Once they get big enough, have enough equity, we'll either refi or 1031 exchange into bigger properties and just keep on doing that and doing that and doing that.
Yeah, that's awesome. So then the question I have for you, because we're in a rising interest rate environment, right? Rates are no longer at 3%. They're at like 5.5, which I totally agree. In 2018, 2019, like we bought a couple of rentals and I think we're at like 5.5 on those too.
Yep.
Which we're back to 5.5 now. So there's a lot of people that are like, oh my gosh, like, rates are so high. And I'm like, oh, they're really not that high. But I think too often we focus on the interest rate and what we're paying the bank instead of like flipping the coin. And like what you were talking about, where, you've got all this equity that you could potentially tap into to make it go work for you in another asset. Mm-hmm. Right. So do you still think that strategy makes sense today, where maybe someone goes from, we'll call it a 2.9% interest rate to 5% interest rate, but they have access to an extra, I don't know, $100,000, $200,000?
Yeah, I definitely do in a certain situation, right? Where it's like, all right, well, even if you have a 2.9% interest rate, but you have, $500,000 of equity, like I said, in there, and you could take out, $300K of it, like, and you could use that to buy another property. Why wouldn't you, right? Because as long as you see that property continue to grow too, like you're going to build equity real fast, and that's going to grow and grow and grow as well. So, I always think like, what's the end goal, right? Like, a lot of people want cash flow, and I agree with that. Cash flow is absolutely the most important thing. But another way to get to cash flow is to get to equity too, right? Like you can get equity and then 1031 exchange it into cash flowing assets. So if you can, if you have a lot of equity and you don't have capital that you need to access, then yeah, why not? Why not try to pull some of that out and go get something else? And there's so many different ways to do it too. Like you can refi, sure, and lose that 2.9% rate, but you can also HELOC it out, right? You can HELOC it out and not lose your 2.9%, but yeah, you pay a higher interest rate on your HELOC and use that HELOC money to buy stuff with. Like that's absolutely possible. There's lines of credit that you were talking about too, right? There's personal lines of credit, right? There's so many different ways. I was talking to a nurse of mine that was in this situation actually, where he just finished an ADU build in his backyard, and he has like a 3.25% rate on it. He's like, dude, I don't want to refi because I'm quoted at a 5.5%, 6% rate right now. And I was like, okay, well, there's actually ways that you can, other line of credits that you can do, right? So there's something at like First Republic Bank that's a personal line of credit right now that's at a 3.25% rate. Right. And so cool. He didn't have capital, but he can get a personal line of credit at 3.25% rate, right? That isn't, based off your house, but it's based off your debt to income, right? In general, that's a great way to add capital too. So there's, different ways besides just going into Wells Fargo or Bank of America and getting a cash out refi on your property. I mean, there's, a line of credit on your portfolio, right? There's personal line of credits. There's, you can get a HELOC. You could do a refi if you wanted to, right? So
Yeah.
There's different ways. And I think you just got to figure out what the best situation is for what you have in your own, piggy bank at that point, and make the decision from there.
So how often are you like reanalyzing a property and tapping into equity?
I at least try to do it every quarter and just like see where we at with everything, right? And at the end of the year, I absolutely always make a decision on, all right, are we going to sell which property, or are we going to keep them all? And I think it's one of the biggest mistakes that people make, and a mistake that we didn't make in the beginning too, is a lot of people think like, oh, cool, I bought an investment property, I'm an investor now, and they're like, cool, I said it, forget it, and I will never look at it again. I made that mistake for the first year, right? And what I started doing was, when I had a lot more time, like I would evaluate deals every month and like see how they performed, right? Now I probably do it every quarter, right? But with that being said, like, you do want to evaluate that, because then you can maximize your portfolio, right? And see, and that metric I talked about before, that return on equity side of things, I think is such a interesting one, where you're like, all right, well, is my equity working for me as fast as it should be? And so for your listeners too, that may not know what I'm talking about. So there's return on investment, right? Whereas your cash on cash return essentially is what you look at as it's your cash flow for the year divided by your down payment and closing costs, all that stuff. That's your return on investment. Return on equity is your cash flow divided by how much equity you have in the property. Because if you own a property for a few years, at that point, it's going to grow, right? In terms of how much equity you have in there. So what's the opportunity cost, right? If I can move that same equity into another property and get a similar cash on cash return, right? And that's something that's always been interesting to me, is how you kind of step up and grow and grow and grow.
Well, yeah, no, I totally agree with you. And the interesting thing is, like, in our society, we're not taught to think that way, right? Yeah. And it's so interesting when I have these types of conversations and people get it versus people that are just learning it. Because the people that get it, like, we don't care about our interest rate, right? Like, obviously, yeah, we care to a small degree, but if we go from 3.25 to 5, we're like, oh, okay, yeah, we're paying a little bit more interest. But if we're able to redeploy, call it $250,000 into something else that we kind of look forward 10 years and go, okay, is this real estate going to be worth more or less? And when you leverage into something like that, that can be powerful, right? And cash flow is what can pay your bills and can set you financially free. But the appreciation, and I'm sure being in the Bay Area, you can appreciate this, like the appreciation is what really makes you wealthy.
Oh yeah, 100%.
Yeah.
And yeah, man, I mean, there's so many different ways, and we're doing some deals right now where we are cash out refining. And, actually what we're doing is, we're taking, DSCR loans, which is debt service coverage ratio loans. And right now they're at like 6.5%, 7%. But what we're asking for, actually, to be more creative, is let me get interest only on that, right? Let me get interest only on those, so that I'm not paying PIT on it, I'm just paying interest. And let me get a no prepayment penalty. I'll pay an extra, quarter point for that. And I don't really care what rate it is, right? Because it's interest only, right? So that 7%, rate at interest only, that is really high. That actual monthly payment is probably just as much as a 4.5% rate PITI. Mm-hmm. Right. And cool. So my cash flow isn't changing. My cash flow is actually staying the same, but I also have a no prepayment penalty on it too. So it's like, when rates inevitably do go back down. So I'm not saying it's going to go down this year, but if there is a recession that comes up in the next few years, the Fed typically in those kind of situations lowers interest rates so they can spur the economy again. And so at that point, what we're planning on doing is then rate refining into the cheaper debt again. And so we just kind of got to know, like, one, like, I always think there's like three things that, everyone should look at, especially right now in this cycle, is one, what's my exit strategy of a property? Two, like, what do I think the market will be? What's the market cycle going to be at when I try to exit? And three, do I have the right loan, right, for those first two, the exit strategy and the market cycle that's going to be in, right? So I think that's like a perfect example I just talked about that. Think kind of like ahead of like, where do I think it's going to be in a few years? And then let me kind of backtrack into what kind of loan I get on the front end.
Yeah, that's so good. So do you believe that, like, if someone buys a rental property, that they're going to keep it for 30 years, or that they should keep it for 30 years?
In the beginning of my life, I thought I would. And every property we've either refinanced or have 1031 sold, right? So like, I think that the 30-year fixed mortgage is great. It's very secure for sure. But we've actually kind of even looked at like 10-year ARMs now too, where it's like, well, are we going to do something in the 10-year period? Probably in that property. Like I probably will sell it or whatever. And then in commercial, right, it's 10-year fixed. We have 10-year fixed. So it's like in that 10-year period, am I going to do something? Probably still. Right. So I mean, in the very beginning, it's absolutely safer. And the first like 5 properties we bought, we all had 30-year fixes on it. And I still think that's the most secure loan that you can get. So it also depends on your risk tolerance. But if you know that you're going to do something, and if you are like a real estate investor as an identity, like that's what you do, you're always reevaluating every year, like you said, and saying, hey, is it a good opportunity to pull money out? Is it a good opportunity to sell? And, 10 years is a long, long time, man. I don't even remember what I did last month versus 10 years ago. So, I always feel like, if you are active in investing, you're always going to find something to do with that property, because at that point, it's either interest rate environment has changed in some capacity or it's gone up a lot in value, and you're probably going to do something with it too.
Yeah. And that's interesting. I hope people can kind of hear the progression of an investor, because I started out very similar, right? And I think most people do, where they're like, no, I'm going to buy this property. I'm going to let the tenants pay it off for 30 years. And I'm not going to have to touch it. But then like, dude, life changes. Calvin's not the same today as he was 7 years ago. His risk tolerance might change a little bit. He might go, hey, I'm, instead of being in the Bay Area, I'm going to take this house that's gone from, being worth 1.5 million to 3 million. And I'm going to go deploy that money into an apartment complex, in Kentucky or wherever, right? Like, and you kind of grow as an investor as your life changes and you start looking for different things. The cool thing though, is like, you guys have stayed consistent in the game, right? You've bought a deal, you've saved up, you bought another deal, you learned how to do it a little bit better, you learned how to do it a little bit bigger, and you guys progressed, right? And now you're kind of at the place where, hey, dude, I love that you guys look at your portfolio every single year and you're like, hey, which ones are we going to off next year? And which ones should we refi because we've got a ton of equity? Because at a certain point, if something's cash flowing a ton, that's great. But if you've got a ton of equity in there and you can go and buy more things that more tenants are paying off, in my opinion, and I'd love to hear your opinion on this, I actually think it's less risky to go and buy more assets versus to just keep the one you've got. Because at a certain point, we're not up to 161 doors yet. We're at 28 and I've got another 22 in escrow. But I look at it and I'm like, what's the probability of all my tenants not paying rent next month? It's pretty low, right? But if I double my portfolio size and let's say I go from 30 to 60 or 60 to 120, what's the probability then? It's probably even lower because more people are paying rent, right? And that's kind of how our system is set up. Like, you go to school to go get a good job, to work Monday through Friday, to pay your bills and enjoy the weekend, and then go and do it all again, right? And if you can look at it and do what we do, which is we provide housing, right, at market rates, we provide good, safe, clean housing, and someone's paying to live there. Not everyone's wired to be a homeowner, and that's okay. But they're essentially little employees, right? Yeah. So I mean, do you agree with that statement? Do you think by going bigger, it's less risky, or do you think it's more risky?
No, I absolutely agree with that. I think in the beginning of my investment career, I thought it was more risky because they're like, oh my God, I have so much more debt, right? Debt and so much more risk. But really, it's you're de-risking yourself because you have more economies of scale at that point, right? Like you said, even multifamily in general, it's cool. One person leaves, cool. I got 4 other people paying, or I got 20 other people paying, or whatever it is, right? And I think that's a big thing that people can't conceptualize. It's you go bigger. And actually, it's funny is, and I'll kind of put it in a frame here. It's sometimes going bigger is actually less risky, right? I had a student that was like, oh, I want to buy a property, but I'm going to buy a $40,000 property first because I don't want to put that much risk in it. I was like, dude, that's actually more risky because you're buying a $40,000 property. You know what kind of property it's going to be? It's going to be a crap ass property in a bad neighborhood, right? So really, you kind of want to go bigger in terms of what kind of property you buy, because it's going to be less risky, right? Because you buy a $250,000 property in that same city, this is in Memphis, you're probably going to be in a B class neighborhood, right? And that's going to be less risky than a D class neighborhood that you're going to buy in. So your perceived risk is totally different when you're thinking like, and that may be more of a scarcity mindset versus abundance mindset, right? Of like, oh, I put less money in, so it's less risky. Well, that's not always the case, right? It's more risky because it's in a bad area, right? Like de-risk yourself by going bigger, because now you can, one, if it's, a conscious scale, right? Going conscious scale, or two, like being in a better area, right? That's always going to de-risk your portfolio too.
Yeah, man, that's so good. Cool. Well, knowing what you know now, and you may have answered it before, but I'll ask the question. What would you have done differently on your journey to financial freedom?
Yeah, I think, a couple of things. One is just going bigger, faster. I think all of us have in the beginning kind of the self-worth imposter syndrome in the beginning, right? And I won't say here and say like I didn't have that. I absolutely had that. And really just ask yourself, like, what's really true in that? Like, I remember when I first started, I went to a conference and someone had 10 doors there. I was like, wow, 10 doors. That's amazing. Like, if I could have 10 doors in my life, I'd be set. That'd be awesome, right? Man, if I had a time machine, man, I'd go back in time and slap myself in the face, dude. I'm like, dude, you're thinking way too small, because we totally always underestimate what we do in 10 years and overestimate what we do in 1 year, right? And that was definitely it, where I just thought that I was only worthy enough to maybe have 10 properties in my life. And and I think just being able to kind of change that mindset would be one thing I would go back in time and say, dude, like, no, you can do this. Like, why not? Right. And if you surround yourself with the right people, you give yourself the right knowledge, and you find the right mentors, like, do anything is possible.
Yeah. Well, dude, that advice is golden. And I know for me, like, mentors and education has been huge, right? Like, the funny thing is, like, we as a people have been conditioned to be like, hey, it's okay to go spend $100, $200, $500,000 to get an education at this university.
Yeah.
Right. Like, I'm in Utah. So, Utah State University, Brigham Young University, University of Utah, like, those are all big universities here. And that's okay. Right. But if you go to a different, like, alternative education platform, like, there's guys that teach on apartments and there's guys that teach on whatever else. Right. But like, that's somehow not okay. Right. Like, people are like, why are you spending that much money? But they'll totally accept you spending 5, 10, 15 times as much at a state-sponsored university where you learn next to nothing as far as like relevant skills go, right?
Yeah.
So, I mean, dude, you guys are doing Zen Coast University, which I've been watching like a little fly on the wall, and I think it's phenomenal. You guys just had a retreat here. Everything you did, like, breaking people's mindsets, kind of like we talked about here, educating people, like, people are taking action. I'm like watching some of your students like go and buy these deals. And maybe speak to us a little bit on what Zen Coast University is, why you got it started, and how people can get involved if that seems like a fit for them.
Yeah, man. I love what you said there too, with like college in general. Like, I went to college, and like the amount of things I actually use from what I learned in college is almost nothing. I learned how to socialize and maybe drink with people, right? That's about it. And and you're right. Like, society dictates, like, this is something that you need to do, and you need to spend $100,000 on, right? But then when it comes to something like financial literacy or whatever, it's like people are like, whoa, why would you do that, right? Even my own parents. I mean, we've been part of coaching programs when we're students, and you spend money, you spend like 20 grand, 50 grand on it. And they're like, whoa, holy crap, why would you do that? But that's made me back so much more money in my life in general. And so kind of for us, man, the philosophy, for us was a lot about, why we even got started was, I guess early on in my investment career, I was very achievement focused, right? So achievement focused meaning that the only thing I cared about, to be honest, was passive income, door count, like net worth, all that stuff, right? And I think a lot of people's goals, especially in real estate investing, their first goal, like tier one, is always like $10,000 a month. I don't know why that's always the goal, but it just sounds awesome, right? So that was always my goal, right? $10,000 a month. If I get there, I'll be happy, right? And when we hit that a few years ago, right? Like, I think it was in like 2017, 2018, I was like, awesome. I got a maid. I'll be happy, whatever. Like, I'll be happy. And, what happened was nothing, dude. I wasn't right at all. It was empty. I remember, when I hit that milestone, I was like, oh yeah, like, this is gonna be awesome. Like, I did it. And what happened was I just ended up being on the couch and, being comfortable watching Netflix, eating Cheetos off my belly and stuff, and like being very complacent. And to be fair, the first week was pretty awesome. Like, it's really cool to do that. But then the second week, you're like, what am I doing? Third week, you're like, what am I doing in my life? Right. And I remember my wife came up to me, a girlfriend at the time, like she came up and challenged me. She's like, dude, like, this is not the person I want to marry. Like, this is not the ambitious person that I saw. Like, what's going on? Right. And that really changed my perspective of like, right, like you're right. I gotta get myself together. Like, it isn't all about the money, and that cliche of money buys happiness. It doesn't. It can help for sure, but like, it's still pretty empty if that's the outcome. And really, I changed my perspective more into purpose-driven results, right? More mission-driven. And my mission was more about like, well, I've been missing in my life was more about like, making impact like on people and changing people's lives. And I had known from the past, we had mentored people on a one-on-one basis back then. And that always made me feel really, really good, right? When they're like, wow, this is so awesome. Like, thank you so much for changing my life. Like, no amount of money or rent check or property that you buy makes you feel that way. Like, it hits differently. And so we were like, hey, you know what? This real estate thing's been pretty good to us. Like, what if we could help, Mike, buy real estate and change direction and trajectory of his family and his life? And they could do that to someone else in their community, and they could do that to someone else in their community, right? And then there's this compound effect of impact that I was like, man, I could be really excited about that. I could be on my deathbed and say, you know what? I'd be okay to die because, I was able to make an impact on this world. And so that's how we created Zen Coast University, right? So Zen Coast University is our coaching program where we want to go and teach people not only how to invest in real estate the right way, right? But more about like how to become a good person along the way and meeting the right people and being around other people that are like-minded, that you can have relationships for the rest of your life. Because from what I know, like just even being in GoBundance and being a part of the community there, it's like, it's lifelong friendships. Like Jordy, you, Jay, all these guys like that I call like people that, I take a blood for in a way. And it's like, dude, like you can't buy that, man. Like that's gotta be earned. And, that's all about, being part of the community and being around other people that are like-minded and helping each other out. And that's what I love about that aspect. And that's what we built with Zen Coast, is having that culture of, building people up together, right? I have a quote that I would get tattooed on my body. My wife would let me get a tattoo, but it's called, if you want to go fast, you can go alone. If you want to go far, you go together, right? And it speaks so well to like just life in general, man. So yeah, man, if anyone is interested in being a part of a community to learn about, real estate investing, sure. But more importantly, how to live a life of abundance, of where, one of my students said, why he got into real estate was, his son asked him if he could drive him to school one day. And he's like, crap, I can't, I got work. Like, and I want everyone that has a family that, that wants to spend time with them to be able to say, yeah, absolutely. So I'm gonna get in. Like, I'll take you, I'll drive you to school, but I'll also pick you up and take you to dinner after. Right. Like, to me, like, having the time and energy to do that with the people you love is what's really important. And that's what we're all about. So.
Man, that's so good. Cause I mean, that's what's most important, right? Like relationships, the money, like as soon as you get a little bit of money, it means a lot less. But the relationships and just how deep you guys go with your students and friends and colleagues in Zen Coast University, at least from what I've seen, outsider looking in, is it's awesome. I think you guys are changing lives. And I think if anyone's listening and they're looking for something like that, like, man, there's no better place that you can learn and grow. And, one of my mentors has advised me, he said, you should be spending 10% of your gross annual income investing in your personal growth. Right. And I took that to heart. And, obviously we throw GoBundance in there. Courtney and I are a part of a couples mastermind. And, like it's hard to write those checks, but the value and the growth and who you can step into when you enter those bigger rooms, like it's totally worth it because you're investing in yourself. And I personally think if you invest in yourself, like you're never going to regret that sort of an investment versus like, it's easy to calculate, how much cash on cash return you're going to get if you go buy a $500,000 property and put $100,000 down and make $100 a month, right? Like that's easy. The hard thing is when you go and you join Zen Coast University or GoBundance or any other mastermind, like you write the check, but then it's not like, you're getting deposits into your bank account. But then the weird thing is like, and you've probably seen this and experienced this in your life, but like the universe, like if you're all in and you're invested and you're like playing full out, if you will. Like, dude, the universe like brings more stuff back to you because it's almost like, it's like, oh, well, hey, he or she is handling what they have really well. Right. And so, let's give them a little bit more responsibility, whatever that may be.
Yeah.
And like, dude, like stuff just like comes together, right? Like hindsight being 2020, I look back, had I never joined GoBundance, I never would have met Mike Ayala. Had I never met him, we never would have joined his couples mastermind. In that couples mastermind that we've been a part of for 2 years, like we've met an incredible amount of couples. There's been some really cool, like spin-off things in addition to just like phenomenal relationships.
Yeah.
But there's been some cool spin-off things where I'm like, oh, hey, like I'm going to connect these two people because they're, kind of looking to do something similar. And I connect them. And then all of a sudden, like the thing that they do together, like blows up. And I'm like, man, that is really cool to see them succeeding. Right. Like, and the interesting thing is like, I, along the way, became a better person. Like I became more in tune with other people's needs, and I'm nowhere near perfect. Like it's that whole growth that you're talking about, like as a person year over year, like that, I don't think everyone should live the same year 50 times over.
Yeah.
Right. They should get in something that challenges them. And like, hey, maybe the first one you join, you hate it.
Yeah.
But don't give up. Right. Like go do something else, go look for something else. Cause just like rental properties, that kind of personal development grows in areas that you never imagine, and it can compound. Right. Kind of like you were talking about with the seeds. So that was a very long-winded way of me putting a bow on Zen Coast University that, if anyone's looking to get into a bigger room, look it up. We'll throw the link in the show notes. Calvin is an amazing person. His wife is amazing. They run an amazing program, and go follow him on social media. So we'll also throw your IG handle in there and everything. So Calvin, thank you so much for the time today. I know you got a ton going on, so we'll see you soon.
Yeah, Jordan, appreciate it, man. Thanks.
Okay, we'll talk to you soon. Thank you for joining me for another episode of the Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.